Welcome back to the deep dive. So you sent us a fascinating stack of sources comparing two absolute titans of the investment world. We're talking about the SPDR S&P 500 ETF, which everyone just calls SPY,
Right.
and the Invesco QQQ Trust, or just QQQ.
It really is the ultimate showdown, isn't it? And our mission today is to, cut through all the noise. We're going to dissect these two funds, cost, performance, risk, everything, to help you figure out which one might actually fit your goals.
And I think we have to start with a fundamental difference, the index they track. That's what dictates the entire strategy. SPY follows the S&P 500. It's designed to be, well, the U.S. economy in a bottle.
Exactly. It's the benchmark for a reason. But QQQ, it traps the NASDAQ 100, and that's a whole different ballgame. It's specifically the 100 largest non-financial companies on the NASDAQ.
Which in practice means one thing: tech.
So much tech. It's heavily tilted towards technology and growth, whereas SPY is spread across all 11 sectors. And that one difference really colors everything else we're about to discuss.
Okay, let's dive into that. First stop, scale. And maybe more importantly, cost. The size difference alone is pretty staggering. SPY is just a juggernaut. It's got, what, around $701 billion in assets under management?
Yeah, as of late 2025. I mean, it's massive. QQQ is still huge, of course, at around $403 billion. But SPY is just the older, more established player in the room.
But size isn't everything. Cost is what eats away at your returns over decades. Let's talk about the expense ratio.
This is critical.
And here, SPY looks like a bargain. The expense ratio is just 0.09%. It's incredibly cheap.
It is.
But QQQ is 0.20%.
More than double.
Why? Why is it so much more expensive? Is it just harder to manage?
That's a great question. And it's not just about scale. Tracking the S&P 500 is relatively straightforward. The stocks are incredibly liquid. The NASDAQ 100, though, it has more complex rules. It kicks out all financial companies, for instance. And the concentration in those top names means it has to be rebalanced more carefully.
So you're essentially paying a premium for that concentration.
You're paying those extra 11 basis points for a more focused, you could almost say more aggressive strategy, even though it's still technically a passive fund.
And over 30 or 40 years, that difference really starts to compound against you.
It's a constant headwind, a small one, but it's always there. And then you add the dividend yield on top of that.
Right. For anyone looking for income, this is not even a close fight. SPY's yield is 1.06%.
And QQQ.
It's way lower, 0.46%.
And that tells you a lot about the companies inside, doesn't it? SPY holds all these mature, stable companies in sectors like energy and industrials. They actually pay dividends. They return capital to shareholders.
Whereas the big tech names in QQQ are all about growth.
All about it. They're reinvesting every penny they can back into the business to get bigger faster. Dividends aren't the priority.
So just looking at this first segment, if your main goals are minimizing fees and maximizing income, the choice seems pretty clear.
It's SPY, hands down. It's built for cost efficiency and stability, no question.
Okay, so let's move on from cost and talk about what you're actually buying. Let's look under the hood.
This is where it gets really interesting.
We know STY tracks the S&P 500. It holds about 503 different companies. It's been around for almost 33 years. It's the definition of broad market exposure.
I like to call it the cruise ship. It's big, it's sturdy, it navigates smoothly, and everyone trusts it to get them to their destination.
And QQQ.
QQQ is the high-performance speedboat. It only has 101 stocks. It's faster, it's more agile, but you're going to feel every single wave.
And you really see that in the sector breakdown. SPY is pretty balanced. Technology is the biggest at 35%.
Right.
Then you've got financials at 14%, consumer discretionary at 11%. It covers the board.
Now compare that to QQQ. This is where you see the speedboat's engine. The data shows it's a staggering 55% in technology.
55%.
55. More than half the fund is riding on one single sector. After that, you have communication services at 17% and consumer cyclical at 13%.
That number, 55%, it's a little shocking. I mean, we always talk about diversification as the one free lunch in investing. This isn't diversification. This is a massive concentrated bet.
It's not. It's concentration by design. The whole idea is that mega cap tech is what's driving the economy now. So if you concentrate there, you get a bigger piece of the growth.
And what's really wild is that when you look at the very top holdings, they're the same.
They're identical. NVIDIA, Microsoft, and Apple, they're so huge, they dominate both funds.
But the weighting is where the story is. In QQQ, Just those three stocks make up 25.57% of the entire fund.
Think about that. A quarter of your money is in just 3 companies.
And in SPY, those same three companies are only 20.7%.
That difference, that's almost 5 percentage points.
Wow.
And that 5-point gap is the whole game. It's the engine for QQQ's outperformance when the stocks are flying high. But it's also its Achilles heel.
Because if even one of them stumbles,
QQQ gets hit much, much harder than SPY.
that is a perfect transition to risk and performance. Because investors will take that risk if the returns are there.
Absolutely. And the first way to measure that risk is beta. It just tells you how volatile a fund is compared to the S&P 500.
Which, by definition, has a beta of 1.0.
Exactly.
And the sources show QQQ's beta is 1.19.
So that number confirms everything we just said. It means when the market goes up 1%, QQQ tends to go up about 1.19%.
But the reverse is also true.
And that's the crucial part. When the market drops 1%, QQQ tends to drop 1.19%. You are signing up for a bumpier ride, period.
So did that bumpier ride pay off? Looking at the trailing 12 months in the data, the answer is a clear yes. QQQ returned 18.97%.
Almost 19%.
And SPY?
SPY was at 15.13%. So QQQ beat it by almost 4 percentage points. That's the reward for taking on that tech risk.
That's the alpha you're chasing. And if you zoom out to 5 years, the picture gets even clearer. If you put $1,000 in 5 years ago, that $1,000 in QQQ would have grown to $1,990.
So you nearly doubled your money.
Nearly doubled it. With SPY, the same $1,000 grew to $1,844. Still fantastic, but clearly lagging.
No question, QQQ has been the performance winner over the last half-decade, driven entirely by that mega-cap tech run.
Okay, but now for the other side of that coin. How bad did it hurt on the way down? We have to look at the max drawdown.
Yes, the peak-to-trough drop. This tells you how much pain you would have had to endure.
And for QQQ, it's a big number. A max drawdown of negative 35.12%.
Oof. So at some point, you would have looked at your account and seen more than a third of your investment just gone. Temporarily, but still.
And SPY's drawdown, it was significantly less painful, negative 24.5%.
That 10-point difference is everything. It's the psychological price you pay for QQQ's higher returns. It's the difference between a bad correction and a truly gut-wrenching, should I sell everything moment.
You have to be honest with yourself about whether you can handle that.
Yeah.
Seeing your portfolio down 35% is not an abstract concept when it happens.
You really have to internalize that trade-off. The outperformance is real, but it comes with much sharper teeth on the downside.
Which brings us perfectly to our final segment.
Yeah.
Tying this all together for you. It really boils down to a conflict between two philosophies, doesn't it?
It does. It's stability and cost versus higher growth potential and volatility.
The sources basically paint SPY as the sleep well at night fund.
That's a perfect way to put it. It's designed to just mirror the U.S. market. The diversification is built in to cushion you from any one sector blowing up.
Whereas QQQ is the go for gold strategy. It's making a high conviction bet that a handful of tech innovators will continue to lead the market.
So let's make this really clear for you based on the material. You should probably lean toward SPY if you're looking for a stable core for your portfolio.
If you want maximum diversification across all the sectors.
Right. And if you want to maximize your income from dividends and, of course, minimize your annual fees, it's the perfect foundation for a set-it-and-forget-it investor.
Okay, so then who is QQQ for? Who should be looking at that higher performance and thinking, that's for me?
You should prefer QQQ. If your #1 goal is higher growth potential, and this is the big one, you have a higher tolerance for risk.
You have to be okay with that higher beta.
You have to be prepared for those 35% drawdowns. And fundamentally, you have to believe that the biggest tech companies are going to keep outperforming everything else for a long, long time.
It's a clean choice then. It's not about which one is better. It's about which one's philosophy matches your own.
Exactly. They are both incredible tools, fantastically liquid, well-run funds. They just serve different masters.
So we've covered the costs, the holdings, the performance, and the risk. The deep dive really confirms that both SPY and QQQ are phenomenal ways to invest in the U.S. market. But the final decision really comes down to what you're trying to build and how bumpy of a ride you're willing to take to get there.
And that leads us right into our final provocative thought. Something for you to really think about. We talked a lot about that concentration difference, that nearly 5 percentage point gap in weighting between SPY and QQQ for just 3 stocks: NVIDIA, Microsoft, and Apple.
That concentration is the secret sauce. It's what drives QQQ's incredible returns, but it's also what causes its painful drops. So the question for you to ponder is this. If you were building your portfolio from scratch today, knowing everything you know about how much those three companies drive the entire market,
How much of your portfolio would you want to have riding on their success? Is it 20%, 25, more?
your answer to that single question probably tells you everything you need to know about whether you're a SPY investor or a QQQ investor at heart.
Thank you for joining us for this deep dive.
Until next time, keep digging into those details.